Okay, we got some new news from the Fed. We've got some conflict on whether we're in a recession or not. Rates are up, prices are relaxing though. So, what does this all mean for you? Let's get into it here in this market update. All right, so what you're looking at here is the live trading of mortgage-backed securities that we show every time. Remember, this is a price chart, so the lower the price on the chart, the higher the rate, and vice versa. If we scroll back, you see just since January, prices have fallen quite a bit, as much as 900 basis points, which is around 3.5% increase in interest rate. But as you can also see, since June, the middle of June, we've had quite a rally, and prices have gone up from about 98. This is a mortgage-backed security chart, so this is tied to the Fannie Mae UMBS 30-year 4.5% coupon. So if you've got TradingView or some other kind of TA technical analysis tool, you can actually see this live and save this chart. But it's rallied about 300 basis points. So getting a third of that back, which is great, frankly. So it's interesting to note that this happened. If you notice when this rally started, you go back and look, you'll see that's actually when the Fed raised the Fed funds rate last time. They meet every 6 weeks. They raised at a point, and everybody was like, interest rates going up. I got calls from NBC and some of the local news stations here. They always call me, and what does this mean? It's like, it's probably going to be good news in the short term, because it's the only tool that the Fed has to fight inflation. So it's very important to remember that. They can only fight inflation. They got limited options. And so inflation is the arch enemy of bonds. The more that gets out of control, higher interest rates go, mortgage interest rates go. So even though when they raise this interest rate, it does affect credit cards, lines of credit, obviously the overnight rate, the rate banks borrow money from each other, so credit gets more expensive in those arenas, and that's not great in the short term, but it's necessary. But for mortgage interest rates, it actually does help. So today, when I'm recording this video, you're probably not getting it till tomorrow or the following week if you're on this HomeBot digest that we send out every month. But this day here, this rally is from the Fed raising it another 0.75%. So in the short term, it is good news. And Jerome Powell, when he spoke, also said, "Hey, we're going to continue to tighten and reduce the balance sheet." So there may be another rally where we could test maybe a little bit higher than this, maybe up to this 100-day moving average here, right? So this means that if you got pre-approved in the middle of June, you've seen rates improve, which is good news for you. And if you got improved really for most of the month of May, except for 1 week, we're getting back to that area. So that is good for you, again, in the short term. And prices on homes, for the first time, we have seen that they're not asking for full list or over list, right? We've seen many come in with under list price or at list price with seller concessions. So if you've been losing heart and losing maybe a little bit of hope out there shopping for a home, this may be a good encouragement for you. You can maybe make some of those deals happen, which is good news. What you need to know is that long term, as inflation continues to rise, which it will, if you go back to the Carter era way they counted CPI, consumer price index, we'd actually be closer to 20% inflation. They changed it because they're always trying to change it to keep things not looking so bad, I feel like. In the last 20 years, they made some big changes to how they calculate that, and so it looks lower. But inflation is expensive. You see it in your food, your gas, your energy, right? And it's a type of tax. And so you feel it, and it's important to understand it as that continues to get out of control. Interest rates will rise. So you want to take advantage when there's short-term opportunities where we see some reprieve and see a rally. So take advantage of that. One other thing to note that goes along with that is when you are in a recession, which we are, it won't be official for another 4 or 5 months, right? Because they don't get the data officially and don't calculate it all until, like when we went in the recession in 2008, we were officially in a recession in the second quarter, but we didn't know till December, right? They didn't officially come out with those numbers. So 10 out of the 10 times that we've had 2 consecutive quarters of negative GDP growth, we've been classified in a recession. So we're in one now, right? It happens. It's cyclical, Don't worry about it, right? We just got to act differently with it. So it's important to understand this as you're looking at your home loan. and the purchase price you're going to pay and how you're going to structure it, there are some different strategies that you want to consider. It may be time to consider putting less down, taking some of that extra bonus money if you're selling a home, right, that you weren't expecting to get and way above your average appreciation levels. Let's put that to some better use. You may want to consider talking with your financial advisors and see if there's some other, if you've got really good ones. If you don't, we'll connect you on how to leverage that better. Maybe pay off some higher interest rate debt with it instead, and look at leveraging it on your mortgage and keeping extra capital. You want extra capital, twice as much reserves as you would normally have in recession and inflationary times, right? And then the good news is within 24, 36 months of a recession, every time interest rates have a reprieve of 1.5 to 2 points, okay? So you've got a good opportunity to get in at a good home now, right? Leverage it and then be able to refinance probably to better terms later, but make sure you keep enough capital now to weather the storm. And the good news about that, and I've sent some videos on this, we can do an analysis on this, and we can send you an updated one as well, that if you were going to put 20% down, for example, and you put 10% down instead, well, your payment's going to be higher, right? You can carve out 5% of that down payment. Let's say it's a $500,000 home, $25,000 of that to help pay the difference. You set it in a side account and you pull from that account every month to help pay the difference between the payment you would have had at 20% down and the payment you actually had at 10% down. Typically lasts you 5 years, but now you got an extra 25 grand as well that you can just have in reserves. Does that make sense? That's the loose version of it. So in recessionary time and inflationary times, leverage more tax beneficial debt like a mortgage, keep extra capital, and look at different ways with your financial advisor and with your debt structure on how to limit those debts, but keep the good debts like this, because this debt will be cheaper to pay off with future dollars when they're worth less. That's just how it works. It's okay. It happens. Be smart about it. Look for those opportunities. Good deals are still there and actually better than they have been. So take advantage. If you got questions, call us. We appreciate you, and we'd love to work with you, your friends, your family that need this type of advice. If you find it helpful, we'd love the connection, because we want to make sure people are getting taken care of in this market and getting real advice and truth and not just stupid marketing ads. All right. Appreciate you. We're in your corner, and we're just a phone call away if you need us. Happy hunting.